In October 2008, the United States government handed $700 billion to the same banks that just destroyed the global economy. And the official story? The one you were told in school, the one that got turned into movies, the one that made a few guys famous for seeing it coming, goes something like this. Reckless bankers made bad bets on housing, the whole thing blew up, the government bailed them out, some regulations got passed, and we moved on. Clean story. Tidy ending. Except that's not what happened. Because there's a version of the 2008 financial crisis that almost nobody talks about. A version where the thing that actually destroyed the global economy wasn't the housing market at all. It was something nobody had ever heard of. Something so obscure that even the people inside the banks didn't fully understand what they were holding. And by the time anyone figured out what it was, $11 trillion in American household wealth had already vanished. So today, we're going to talk about the crash nobody warned you about. Because the real story of 2008 isn't about greed. Greed is always there. The real story is about something much more dangerous. It's about a system that convinced itself it had eliminated risk entirely. It hadn't.
Here's what makes 2008 so strange. In 2006, the year before everything started falling apart, the US economy looked completely fine. Better than fine. Unemployment was at 4.4%, which was near a 30-year low. GDP growth was strong. Corporate profits were at record highs. Home prices had been climbing for a decade straight. And the stock market was at all-time highs. But at the exact same moment, buried inside the financial system, something like $58 trillion in financial contracts had been quietly written on top of those mortgages. Contracts nobody could value. Contracts nobody could trade. Contracts that were sitting on the balance sheets of almost every major bank in the world. So while the surface of the economy looked like the healthiest it had ever been, underneath it, the entire global financial system was sitting on a bomb. And almost nobody knew the bomb was there. Which raises the only question
that actually matters here. How do you build a bomb that size inside a financial system and have nobody notice? Well, to answer that, we need to back up. And we need to start with a house. Because it always starts with a house. In 2003, you could walk into almost any bank in America and get a mortgage. Even if you had no income, even if you had no job, even if you had no assets. There were actually loans being written at the time called ninja loans. No income, no job, no assets. And the bank would still give you a mortgage. Now, that sounds insane. And it is insane. But here's the part that actually makes sense from the bank's perspective. And this is the key to understanding everything. The bank didn't plan on keeping your mortgage. This is the thing that changed everything. For most of financial history, when a bank gave you a mortgage, they kept that loan on their books. They owned it, which meant if you stopped paying, it was their problem. So they were very careful about who they lent to because their money was on the line. But starting in the 1970s and accelerating rapidly through the 1990s and 2000s, banks discovered they could do something else. They could take your mortgage, bundle it together with thousands of other mortgages, and sell that bundle to investors as a bond. A mortgage-backed security, a MBS. Now, suddenly, the bank's money wasn't on the line anymore. They sold the risk to someone else. They collected their fee, and they moved on to write the next mortgage. This is what economists call the originate-to-distribute model. And on paper, it sounds reasonable. Banks originate loans, investors distribute the risk across the global financial system. Risk gets spread around. Everyone's safer. Except it created one very dangerous problem. If the bank doesn't keep the loan, the bank doesn't care if the loan is good. And that incentive problem is where the whole thing starts to rot. But here's the part of the story you never hear. Because mortgage-backed securities aren't even the real villain here. Everybody knows about those now. The real weapon that turned a housing downturn into a global financial catastrophe was something else. It was called a collateralized debt obligation, a CDO. Think of it this way. You take 1,000 mortgages, bundle them together into a mortgage-backed security. Then you take 100 of those mortgage-backed securities, bundle them together into a new product. That's a CDO. It's a bundle of bundles. Debt on top of debt on top of debt.
And the ratings agencies, Moody's, S&P, Fitch, the organizations whose entire job is to tell investors how risky a financial product is, looked at these CDOs and gave enormous portions of them their highest possible rating. AAA, the same rating given to US government bonds. The same rating that means this is as safe as it gets. And here's why they could do that, at least in theory. Because if you bundle thousands of mortgages together, even if some of them go bad, the logic goes, they won't all go bad at the same time. Risk spreads out. The pool is diversified. The top portion of the CDO is so far from the bad loans that it's essentially risk-free. Except there was one catastrophic flaw in that reasoning. The math assumed housing prices across different parts of America were independent of each other.
That if home prices fell in Miami, that had nothing to do with prices in Phoenix or Las Vegas or Detroit, but that was never true. And when the housing market started turning in 2006, home prices didn't fall in one city. They fell everywhere, all at once, for the same reason. Because they'd all been driven up by the same loose lending standards, the same easy money, the same incentive to issue mortgages to anyone with a pulse. And when that happened, the CDO model, the model that the entire system was built on, turned out to be built on math that only worked if the thing it assumed never happened. And then, the thing it assumed never happened. Now, here's where you need to understand something about scale. Because when people say the 2008 crash, most people picture banks losing money on bad mortgages. And yes, there were a lot of bad mortgages. About $1.2 trillion worth of subprime mortgages were issued in the years before the crisis. $1.2 trillion. That's a lot of money. But here's the number almost nobody talks about. At the peak of the crisis, the total notional value of something called credit default swaps, financial contracts written against those mortgages, was estimated at somewhere between $55 and $62 trillion. Let that land for a second. $1.2 trillion in actual mortgages, $58 trillion in financial contracts written on top of those mortgages. A credit default swap is essentially an insurance policy. You pay someone a premium, and in exchange, if a specific bond defaults, they pay you. Simple enough. Except there was one crucial difference from regular insurance. With regular insurance, car insurance, home insurance, life insurance, the person selling you insurance has to prove they have enough money to actually pay out if something goes wrong. That's called a reserve requirement. It exists for a reason. Credit default swaps had no such requirement, which meant companies like AIG, the largest insurance company in America, could sell essentially unlimited amounts of insurance against CDO defaults, with no obligation to set aside any money to cover what might happen. AIG alone had written about $440 billion in credit default swaps. When the CDOs started defaulting, AIG couldn't pay. And because AIG was connected to every major bank on Earth, if AIG collapsed, it would take the entire global financial system with it. That's the night the government made the call. AIG got $182 billion in emergency government support. Not because they deserved it, but because the alternative was unthinkable. Now, here's where most people stop the story. Banks bad, government bailout, regulations passed, done. But there's something underneath all of this that nobody really talks about. Something that makes 2008 different from every other financial crisis in history. And it's this. For the first time ever, the global financial system had built a machine so complex, so layered, and so interconnected that nobody, not the banks, not the regulators, not the ratings agencies, not even the economists who designed the products, could see the whole thing at once. Joseph Stiglitz, the Nobel Prize-winning economist, put it like this. The financial industry had created instruments so complex that the people creating them didn't understand them, the people selling them didn't understand them, and the people buying them didn't understand them. And that's the part that should scare you, because it wasn't fraud. Not entirely. Most of these people weren't sitting in boardrooms twirling mustaches and laughing about destroying the economy. Most of them genuinely believed the math worked. They had the models, they had the ratings, they had the track record. The problem wasn't malice. The problem was that the system had gotten so complex, so layered with abstractions,
mortgages into securities, into CDOs, into CDO squareds, into synthetic CDOs, that nobody could see what was actually inside it anymore. And if you can't see what's inside it, you can't see when it's broken.
There's a name for this in finance. It's called opacity risk. The risk that comes not from something going wrong, but from nobody being able to tell whether something is going wrong or not. And here's the uncomfortable truth about 2008 that nobody in a position of power will say out loud. The system that caused the crisis was never fully dismantled. It was patched. It was regulated at the edges. Some of the worst products were cleaned up. But the fundamental structure, the originate to distribute model, the complex bundling, the reliance on ratings agencies, the opacity, that's all still there. Which is why, if you want to understand what's happening in credit markets right now, or private credit, or treasury yields, or basically any financial story unfolding today, you have to understand 2008 first. Because almost every crisis that's come since then is running the same basic playbook: complexity, leverage, opacity, and a quiet confidence that this time the math works. It usually doesn't.
So here's what you actually need to take away from this. The 2008 financial crisis wasn't caused by housing prices falling. Housing prices fall. That's normal. The crisis was caused by a system that had built a $58 trillion financial structure on top of a $1.2 trillion foundation, with no way to see inside it, no way to value it, and no requirement to actually be able to pay up when it all went wrong. And by the time that system broke, 8.7 million Americans had lost their jobs. 10 million families had lost their homes, and $11 trillion in household wealth had disappeared. Not to anywhere. It just ceased to exist. That's what opacity risk actually costs when it finally comes due. I want to know, did you learn about any of this in school? Or was the story you got the clean version? Drop it in the comments, because I'm genuinely curious how different the real story feels from what most of us were taught. If you want to understand the financial system that's actually operating right now, not the cleaned up version they teach, subscribe, because this channel is where we follow the paper trail.